Trading is one of the only professions where you're constantly putting your livelihood on the line, where you can lose, not just win. And a lot of people struggle with that because it's different than a lot of other vocations. A lot of people also kind of come into trading thinking it's all lottos and Lambos. You hit a 100 bagger, you retire, you're done. I'll tell you, it's actually a lot more about consistency and small wins, building that up over time. So A, you can improve your confidence in your system and how you're trading and executing, but also B, because you have to be realistic. Not every trade is going to be a lottery winner. And I think it's important to have realistic expectations going in so you don't burn yourself out. There's also another reason you don't want to learn about the fourth shape here. No one wants to really discover that firsthand, but it is part of many traders' journey. Many traders do end up blowing up an account or two or three or even four before they discover consistency or before they just give up. Let's face it, 95% of traders don't make it. What's going to be what makes the difference for you? That's what you really want to ask yourself. How do you beat the odds in a game where the odds are stacked against you? And it's actually a surprisingly simple answer. You put in the work. I know it's not the answer that a lot of people want. There's some secret formula, that hopefully someone could share and then we could all just replicate it. But then, of course, if we're all doing the same thing, it won't work. That's also the beauty of trading, is it's constantly evolving. What used to work isn't going to keep working. What works now may not work in the future. And that's part of the beauty of the game. But going back to risk management, the math doesn't lie. If you're not appreciating how you're managing your risk, you're likely to lose far more than you can easily regain. If you lose 30% of your portfolio, it takes a 43% gain to get back to break even. If you lose 60%, you've got to be up 150%. Think about that math. As you slip down, as you lose capital, and the market doesn't owe you that money back, you owe it to yourself to learn why you lost it in the first place. As you lose that money, it becomes harder and harder to rebuild it. And let me just tell you right now, if you're thinking, boy, I'll just revenge trade my way out of the hole, don't do that. That's really just going to get you hurt even more. And if it ends up working, it's going to form really bad behaviors that will cause you to eventually get hurt. So instead of thinking about, hey, let me just revenge trade back out of, whatever trade I was in, look forward, cleanse your mind, look for other opportunities. Don't look in the rear view with remorse and regret. Bit about me. I've been trading for 21 years. It's been an awesome journey. I've learned so much along the way, and not just about finance, but really about how the whole world economy works, how corporate earnings affect different elements of the economy, how different elements of the economy affect corporate earnings. It's all very interconnected. The macro plumbing, how central banks and fiscal policy impact the markets and the economy. I mean, this all comes together. And if you really do become a student of the markets and you're insatiably curious, you're going to find that it connects to just about everything. And as you go down these various rabbit holes, putting together the pieces and learning more, you start to appreciate just how much having a nuanced view from multiple angles can really help. This is why I like to blend momentum and macro together, for example, for a lot of swing trades. Because when you zoom out, you find that when momentum and macro meet, they tend to be areas of opportunity. Sometimes these trades end up turning into really prolific winners because you have two areas that are giving you some degree of convergence signal. And this is true during day trading as well. I really like to find convergence during day trading as well. I think when you find, for example, a really active call strike, liquidity stacking above, you're breaking above the 20-minute opening range, you've got that convergence of signals suggesting further upside. Now, I know everyone likes to talk about having a strategy, but do you actually follow your strategy? This is something that I like to ask a lot of the traders that I work with, because often is the case, they'll work on a strategy, but they won't follow it once the bell rings. Or they'll start following it, get into a trade, and then immediately stop following that strategy. Why? Because emotion starts to take over, fear and greed, impulse, because we think we're smarter than our strategy, our ego gets in our own head. Or maybe we think, oh boy, this position isn't really a loser. It just went against me initially. I'll just lower my stop. It'll turn around. But see, if your strategy goes against any of those things, then you're not following your strategy, and therefore you're going to get yourself into trouble. Obviously, at the end of the week, it's a good idea to review your trading journal. And if you're not keeping one, I strongly, strongly suggest that you do. And when you review that trading journal, you really want to find out what kind of trades work for you, for your mindset, for how you are wired. I'm using the word you a lot. There's reason. Because we're all wired differently. So if you're trying to trade like me or someone else and you're not wired the same way, it may not end up working for you. We can all learn from each other. There's no doubt that we all have experience and different areas and perspectives to share and learn from. That's fine. But trying to blindly imitate someone else's trading without really understanding the system and coming to appreciate it within your own way of trading, you're going to get in trouble. It's really that simple. Like all the sort of copy trade stuff out there, if you don't 100% understand what's going on and why you're doing it, then what are you even gaining? What is there going to be someone there to show you their trades forever? Or is really the better idea to learn on your own so that you can become more self-sufficient? Obviously, you can learn from other people, but I mean, don't copy exactly what they do. Come to your own decision, create your own trades, discover why they work and don't work on your own so that you can start to become more self-reliant. I know it sounds like a lot of work because it is, but quite frankly, being successful in the market is a lot of work. If you're really serious about this game, you've got to put in the effort, and believe me, it's worth it. If you do put in the effort and you start to become more consistent and you start to learn more about yourself, your demons that keep you out of good trades and keep you in bad trades, for example, once you start to conquer that stuff. And by the way, on my YouTube, I have a great video about trading psychology. It's pinned. Feel free to watch it. It's 42 minutes long. It's a great primer on rewiring your mindset. This isn't something that happens overnight. It's something that, you start with the will to do it. That will starts to change some of your patterns of behavior. Those patterns then evolve into habits, and then you start to kind of rewire your mindset. So it takes time, but it's worth it. The results speak for themselves. Mastering your psychology also has a lot to do with taking a more systematic approach to trading. What that means is you're not just winging it. You're actually building a data-driven approach for entry, exit, risk management, qualifying signals. And then it takes a lot of the guesswork out. No system is going to be perfect, and regimes will evolve, but having that set of guidelines will give you the opportunity to become more consistent and also have a better understanding as to what works and what doesn't work. Let's shift gears to the big picture, what's going on. There's a lot of crazy flows. Remember, I think it was 2 weeks ago, we did a presentation talking about the extremes on the downside, in terms of short positioning, in terms of view on the put side, just everything was saying it was a super well hedged market. Well, guess what? We're now taking the other side of that extreme. So if we look at net call volume, this shows us that this is the highest level of net call volume this market has seen. It's extraordinary. It shows you a level of bullishness that may get us into a little bit of trouble if we start to see the sentiment aggregates and the flow aggregates continue to get very frothy here. And I say that because it's moving the dial. If you look at 1 month out skew on the S&P 500 cash index, it's also super duper bullish. The higher this number goes, the more bullish that skew is. And what I mean by bullish skew is you have a lot of call positions stacked in excess of that of put positions over the next month. And so that's what drags this higher to a level that suggests some degree of complacency or very high levels of optimism or bullishness. There's nothing wrong with that per se, but it means that the kind of trading we may see from here could be more stair step than just sort of these straight up God candles that we've had over the last 3 weeks. We also have significant interest in tech. You'll recall 2 and 3 weeks ago during my presentations, we talked about how tech was really sold down. It looked like there were opportunities building. It was becoming cheap compared to, the broader S&P versus this historical valuation. Positioning had been bottomed out. It was just absolutely looking like a contrarian's dream. And now the opposites happen. Now we have this huge surge. Tech is leading the way, and you can see it in the flow of all the net call volume out there per sector. Tech is absolutely leading this rush. And within tech, our old friend, the semiconductors that are, well, this is historic volume. These are the largest monthly inflows to the semiconductor ETFs that we have ever seen. So you could say there's palpable excitement here. Now let's shift gears to the next chart. This is the Goldman Sachs Vol Panic Index, reverting back to just above 4. This index takes into consideration implied volatility, and a few other factors to create this composite that shows we're not really scared anymore. So we are getting back to some degree of complacency. That is to be expected with the kind of move that we've had. This move was powered by both buying and removal of hedges or short covering, closing out puts, et cetera, et cetera. And we've kind of realized the extent of that part of the move. The FOMO driven and hedging removal part of the move has largely completed, as we can see with these charts. Now it's really much more about earnings season. Now that we're, I would say, deep into earnings season with tech coming right up, it's going to be all about whether we can see some double beats and strong guides from the majors. Another aggregate that's interesting, this is JP Morgan's positioning. This is net leverage across all strategies. And you can see this is also well off of its lows. So just about every aggregate that we can look at shows that positioning has come off of its lows, that the bulls are back. And they have every reason to be. We're back at all-time highs. You've seen that even though the Iran war is not resolved, the impact on the global supply chain has not been quite as problematic as initially suspected, at least yet. There is still time for these things to develop. Moving on to seasonality, EquityClock.com suggests that seasonality for the NASDAQ 100 should improve from here. And really, it does tend to have a pretty solid time all the way through July. Then things tend to get a bit choppy again. August through October can be a little bit more tricky for tech. And market breadth, guess what? We are back to extremely narrow breadth now. This is not the best sign. It just tells you that market leadership has narrowed to a handful of names once again. Doesn't mean that we're at imminent risk just because of this in isolation. But what it tells you is going into earnings season with such a concentrated rally, if any of these companies deviate from the narrative about generative AI and growth and just their own double-digit growth trends, that could be more problematic to a market that's clinging on to less leadership. So it's not like we can look at this in isolation and say, oh boy, we're in trouble, but we can look at it and composite this information based on what's going on in the bigger picture and get some understanding that this does matter. It matters as a risk amplifier, but it doesn't necessarily mean anything in isolation. Also, going into this, before the whole rally really took off, fund managers were taking appreciably lower than normal levels of risk. Which again, I get it. We're at war, there's crazy stuff going on, everyone's getting pretty concerned. Why would you want to pile into the risk in that situation? Fine. But those same folks had to FOMO in and chase this thing higher. And I'm telling you, it was like people were just stepping on each other's toes, running each other over to get in. There was a lot of disorderly buying. It was almost like a crash higher. You typically think of crashes as a move lower, but this kind of felt like a crash higher to me. Let's look at the technicals and the momentum in this market. First thing I want to share is these pivots. These pivots are based on market-generated information, things like volume profile, options, exposure, price action. And basically the idea is if we're above these levels, I'm looking for bullish trades. If we're below these levels, I'm looking for bearish trades in the individual asset in question. So right now, pretty well above these on just about everything. I think silver might be the exception here. Yeah, silver's down to 78.37. So silver just didn't want to come along for the ride here. but everything else is above the levels. S&P futures 71.62 versus 70.44. NASDAQ futures 28.812.25 versus 26.328. And then gold 47.94 versus 47.72. So everything else looking pretty good. Silver just a little bit under the weather here at 78.37 versus 82.05. Speaking of charts, here's a weekly. We're going to zoom out this week to the weekly charts for everything we're covering. So starting with the S&P, I want to point you to the tariff tantrum low, the sort of candles we got off that low, and then looking at the candles we're getting off this low. It's not exactly the same, but it's very similar. You also had a decent amount of volume on both of those reversals. So it's feeling to me like the worst is behind the S&P, at least for now, because this is also a market that is increasingly willing to ignore the war. And you might say, well, how can a market ignore the war? That seems so strange. Well, actually, if you go back in time, prior geopolitical risk catalysts and wars and other things like that, typically the market, like any ADHD person, has a very limited attention span. So it focuses on it, hyper focuses on it, but as time goes on and it doesn't metastasize into something significantly worse, the market tends to look at other things. It tends to look forward and discount the present. That's exactly what's happening right now. And if you look at the analyst expectations for S&P earnings, they are absolutely surging. There wasn't even a blip during this war. There wasn't even a blip to the implied earnings growth. So analysts were looking past this war the entire time. Now markets have kind of followed that practice, looking past the war. And the war itself is not having as much of an impact in the United States as it would have, say, 50 years ago when we were much more dependent on overseas oil. Now we're much more self-sufficient, so it's having a much more limited impact here at home. But other countries that depend on energy and other supplies coming through the strait, they are taking a hit. Let's look at the NASDAQ. NASDAQ also has a very similar look, just a big push off of the low, a decent amount of volume, just like we saw from the April tariff tantrum lows, and continuation. So again, this market also sending us a very similar signal that a reversal is in place and the path of least resistance is higher. But the caveat being, there's been this huge rush in. We saw it in the positioning aggregates and the skew, etc. And we have earnings coming up. So some degree of caution is warranted. That is to say, if you weren't already buying into this move, I'm not so sure that this is the place that I want to start getting long. I want to kind of see how we process earnings, how we process some of these other event volatility catalysts. Gold continues to look structurally sound to me. It's part of this longer-term Bollinger Band breakout, which is essentially an expansion of volatility over time. And we're combining that with some basic trend structure. Going back to the beginning of 2025, we can say that's where this uptrend started, this acceleration phase of the uptrend. And it's still very much intact. In fact, the recent move lower brought us right back to the trend line for a perfect retest and bounce. Silver also has a similar look to it. So both gold and silver, I'm looking for them to start to make a push. But we do need to see, in my opinion at least, some relief on long end rates. I would like to see those long end rates come down just so there's not so much competition for these non-yielding assets like precious metals. And then for silver in particular, we really do need to see some resolution to the Strait of Hormuz issue just so that we can resume some of these projects that relied on energy coming out of there. I wouldn't say it's shutting things down, but it's slowing down activity, and you can see it in the price to some degree. On the other side of it, though, China is a very aggressive buyer of silver here, so I don't think that the silver bull run is even close to over. I still see us revisiting highs and exceeding them over the next year or so. Crude oil, we're watching this with the 8-week moving average. It's pretty similar to the 40-day moving average. It's an EMA or an exponential moving average, and we can see it tends to play well with this EMA. So when we're above it, we can say, okay, we're trending higher. We've just kind of closed above it. We're trading above it again. So it's going to be worth watching crude oil here. Again, the Strait of Hormuz issue isn't resolved. And in fact, there is some signs from Trump's little speech today that we may go back to more escalation. Market doesn't seem to care too much. S&P futures bid up 0.2% ahead of the open in 8 minutes, but that's the sort of headlines that we're going to be contending with probably through the rest of this week. And then finally, Bitcoin. Bitcoin also starting to look a little better, but I'm still concerned this is a lower high before a lower low. The pattern is pretty clear. The overall structural reason for the de-risking in Bitcoin is also still present. Liquidity is still somewhat tight. And Bitcoin tends to be a relief valve for excess speculative liquidity. So we'd really want to see that liquidity improve. And you'd look at it from things like bank reserves. You'd look at it from reverse repos. There's various aggregates of liquidity we can measure, and they're still lower than I think what Bitcoin would want to see. And let's quickly just look at some S&P levels here. These are the options levels that I'm watching this week. These are put together by the SPX options visualizer algo that I built. And then for folks that are tuned in, we've got some cool deals going on. 20% off TraderAid plans using the code Mayhem20. You can visit TraderAid.com and just click on the Trade With Us or join our Discord link. And then 40% off Bookmap for new plans. Scroll down to the special offers using the link TraderAid.com/bookmap.